Most people think investing is all about trying to sell at the absolute tippy top. But what if I told you that's pretty much a fool's game? A truly disciplined investor, they don't guess, they don't gamble, they have an exit strategy before they even get in. So today, we're going to break down a really fascinating, kind of counterintuitive strategy for silver. And it's not about predicting some big crash, it's about executing a plan based on cold, hard data.
Okay, let's just dive right in. Before we can even begin to talk about selling anything, we have to ask a much bigger question, one that I think gets to the absolute core of successful investing. How are you actually measuring your wealth? I mean, really, is it in dollars, or is there a better, more honest way to do it?
Well, here's where it gets interesting, because the truth is often hidden behind the numbers. On one side, you've got the US dollar, a fiat currency that, by its very design, loses purchasing power over time. It's also worth noting that many investors are skeptical of the official inflation numbers. Some even call it the CP lie, because let's be honest, it feels like the real cost of living is going up way faster. But on the other side, you have gold, a real, tangible asset that's been a constant measure of value for, well, centuries. Getting this difference is absolutely the first step.
All right, so let's see how this principle plays out in the real world and how it led to a massive win. We're going to look at a case study from our source that shows this whole strategy in action. And the results, frankly, they were just stunning.
Get this, in just 7 months, investors who saw what was happening watched the price of silver nearly triple. We're talking a jump from around $33 all the way up to nearly $90 per troy ounce. I mean, that is just an explosive, life-changing move.
And look, this wasn't just some number flashing on a screen. As this quote just brilliantly shows, these gains had a real-world impact. People were paying off their credit cards, they were getting rid of student loans, and they were finally able to secure a much more comfortable retirement. That's what this is all about.
So, you're probably asking, what was the secret? What was the signal? Well, here's the crucial point. The trigger to sell wasn't based on a specific dollar price at all. No. It was based on a totally different, much more stable metric that just filters out all the noise of a devaluing currency.
And this really brings us to the core, counterintuitive insight. Why on earth would you measure a real asset, like silver, against a fiat currency that is constantly being devalued? It just doesn't make sense. It's like trying to measure your height with a ruler that's constantly shrinking. You're never going to get a true reading.
Our source really doesn't pull any punches here. Comparing a real asset to the dollar for any kind of long-term analysis is just, well, it's flawed, especially when the inflation data itself is so unreliable. To get a true sense of value, you have to compare it to another constant, and that constant is gold.
So the tool we use for that comparison is called the gold-to-silver ratio, or you'll hear it called the GSR. It sounds complicated, but it's not. All this ratio tells you is how many ounces of silver it takes to buy 1 single ounce of gold. That's it. It's a direct, honest measure of how cheap or expensive silver is relative to gold.
And you're going to love how simple this is. There's no fancy algorithm. You just take the price of 1 ounce of gold, you divide it by the price of 1 ounce of silver, and bam, you've got the ratio. It's an incredibly powerful tool that is accessible to literally any investor.
Okay, so we've got the tool, the gold-to-silver ratio. Now let's look at how you turn that ratio into a clear, actionable plan for buying when silver is cheap and selling when it starts to get expensive. Now, looking back over the last 30 years, you can see this ratio just swings wildly. Sometimes it spikes to over 100. That means silver is historically cheap compared to gold. That's our buy signal. Then other times it drops below 50, which signals that, hey, silver is getting expensive, and it might be time to think about taking some profits. It's a simple theme. You use these historical swings to your advantage. So the big flashing buy signal came when this ratio shot above 100. Our source identified this as a powerful asymmetric bet. What does that mean? It means the potential reward for silver to just return to its historical average was huge, while the potential downside was pretty limited. That's exactly the kind of setup that disciplined investors are always looking for. And on the flip side, this slide brilliantly illustrates the exit trigger. The plan, defined way in advance, wasn't based on a dollar price, it was based on the ratio. As soon as the GSR fell below 50, that was the signal to start taking profits. Why? Because silver was no longer historically cheap relative to gold. Simple as that.
And this is exactly what happened in the case study. The moment that ratio hit the target, 25% of the paper's silver position was sold. Now, because the price had nearly tripled, that one single sale was enough to get back almost the entire initial investment. That means the rest of the position is essentially a free roll. Your risk is off the table.
By the way, if you're finding this explainer valuable, please do us a favor and like, share, and subscribe. That way you really won't miss out on what we break down next.
So, here is a really crucial point, one that a lot of people miss. Selling doesn't mean you run for the hills and start hoarding cash. No, it's a far more strategic move than that. This is about rotation, not liquidation.
Right, and a common question is always, well, why not just buy and hold forever? Or why would you sell if you don't think a big crash is coming? But you know what? Buy and hold can be absolutely nerve-wracking when you're sitting on massive gains. And waiting for some crash that may or may not ever come, well, that just means you're losing purchasing power to inflation every single day you sit in cash.
And this really highlights two totally different mindsets. Liquidation is usually based on fear. You sell everything to cash and you just hope you can time the market perfectly to get back in. Good luck with that. Rotation, on the other hand, is strategy-based. You're simply reallocating capital from an asset that's done really well to another one that might now be undervalued. You're staying invested, you're staying protected.
This entire strategy is built on a really clear set of rules. First, you stay invested to fight that constant currency debasement. You dollar cost average in and out to smooth your returns. You always sell paper assets before your physical ones. And most importantly, you make decisions based on data, like the GSR, not on fear or greed. And you're always ready to rebuild that position if the opportunity comes back around.
This quote just perfectly captures the whole philosophy. Selling a chunk of your silver isn't a bearish call on precious metals, not at all. It's the action of a disciplined investor who is locking in huge gains, reducing their risk, and strategically repositioning their capital for the next opportunity.
And so, we end right back where we started. This strategy really forces you to ask that fundamental question. Are you truly measuring your wealth in a stable asset? Or are you just counting a currency that is literally designed to lose its value over time? Definitely something to think about. Thanks so much for watching.